All right, quick check before you scroll. It's January 30th, 2026, and if you care about silver or honestly about how leveraged markets break, you need to hear this. In the last stretch, silver didn't just dip. It collapsed more than 30%, falling from around $121 an ounce to below 85. That's tens of billions in paper value gone. Fast. And yes, everyone's pointing at Trump's nomination of Kevin Warsh as Fed chair as the headline trigger. But here's the urgent thesis. That wasn't the real cause. That was the spark. The fuel was already everywhere. Stay with me, because I'm going to show you what just happened, why it keeps repeating, and how you can spot this pattern before the next flush, not after. Before I explain what caused this move, let me teach you something most people never really internalize about markets. Prices don't just reflect value, they reflect positioning. Think of a crowded elevator where everyone's leaning on the same wall. It feels stable until someone bumps the door. When leverage piles in, especially in futures markets, price becomes less about supply and demand and more about who's forced to act next. And here's the thing, silver is notorious for this. It's volatile, it's thin relative to its hype, and it attracts leverage like moths to a flame. When everything's calm, it looks strong. When something shifts, it doesn't walk down. It falls through trapdoors. So if you understand that, a lot of what just happened starts to make sense. If this is making sense so far, drop a comment below and let me know where you're watching from. It helps me know who's paying attention to these patterns. Now here's what's actually happening under the hood. Let me break down the sequence because the order matters. First, the Warsh nomination shifted expectations around rates and credibility at the Fed. Markets read that as dollar positive. The dollar moves up, yields firm, and non-yielding assets like silver immediately feel pressure. That's the obvious part everyone sees. But here's what's wild about this move. Silver was already parabolic. Futures positioning was stretched, margin was maxed. So when price slipped through key levels, the selling wasn't discretionary. It was mechanical. Stops hit. Margins got called. Funds had to liquidate. And when forced sellers hit a thin market, price gaps. It doesn't glide. So when that first wave of selling hit, it triggered the second wave. And this is where it gets interesting. Algorithms saw momentum flip, volatility models de-risked, more futures contracts got dumped. That pushed price through 85, which mattered more psychologically than most people realize. Why? Because round numbers act like psychological anchors. Break 85, and suddenly 90 looks far away. Suddenly, people who bought at 100 are looking at real losses. And that's when the cascade really accelerated. But here's the part that should make you nervous. At the same time, paper silver was flushing. Physical markets didn't confirm the move at all. Shanghai prices were hovering near 120. That's a 40% plus premium. Think about what that means. You've got paper contracts in New York saying silver's worth 85. You've got actual physical metal in Shanghai trading at 120. That's not weak demand. That's fractured price discovery. And when paper and physical diverge like that, it doesn't resolve politely. One of them has to give. Either physical comes down, which would mean demand actually collapsed, or paper snaps back up, which would mean this was a technical flush, not a fundamental repricing. History suggests the second one happens more often than people expect. Now let me show you what very few people are talking about. This isn't the first time we've seen this exact playbook. Go back to 2008. Silver didn't gently reprice during the financial crisis. It imploded as leverage unwound, even though long-term fundamentals didn't disappear. Physical metal was still scarce. Industrial demand was still there. But paper price collapsed because futures holders had to sell. They didn't want to sell. They had to. In 2011, after the blow-off top to nearly $50 an ounce, the collapse wasn't about suddenly abundant silver. It was about futures liquidation. Margin requirements got raised. Speculators got flushed. Price fell almost in half in weeks. And in March 2020, during the liquidity crisis, silver crashed while physical premiums exploded. You had dealers selling coins at $30 when spot was under 15. Same movie, different actors. Every single time, the pattern repeats. Leverage dominates price on the way up. Then something breaks the narrative. Could be Fed policy, could be dollar strength, could be margin hikes. Doesn't matter. What matters is the mechanics. When leverage unwinds in a thin market, the move is violent. When physical demand stays firm, the snapback later is just as violent in the other direction. Zoom out and you see the larger story. This isn't about silver being worthless. It's about how futures markets work when everyone's crowded on the same side. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could banks be pushing price lower on purpose to cover shorts or shake out retail? Listen, I've heard every conspiracy theory. I'm not saying manipulation never happens. But here's the thing. Blaming manipulation doesn't help you trade or protect capital. Mechanics do. You don't need villains to explain margin calls. You don't need conspiracies to explain forced liquidation. Focus on what you can verify. Positioning, leverage, spreads, and premiums. Those tell you what phase you're in far better than outrage ever will. Could there be actors benefiting from this move? Absolutely. Does understanding their motives help you know what happens next? Not really. What helps is watching how price behaves at key levels and whether physical markets confirm or reject paper pricing. There are probably three types of people watching this right now. Let me speak to each of you directly. If you're a long-term physical holder, someone who's been stacking silver bars or coins for years, you're probably frustrated, maybe even angry. You're watching paper price collapse while real-world demand stays tight. Your local dealer still has premiums. You can't buy silver at 85. So what gives? Here's what I'll tell you. Your job isn't to panic. It's to watch premiums. If physical stays above 25% premium to spot, this is still a paper event. It means the disconnect between futures and reality hasn't closed. If premiums collapse too, then you've got a different problem. But right now, elevated premiums tell you this flush is technical, not fundamental. If you're a trader, someone who's actually in and out of positions, you're probably thinking, is this done or is 50 next? For you, levels matter more than narratives. Here's what I'm watching. 85 to 80 is panic continuation. If we're chopping in that range with volume staying high, selling isn't exhausted yet. 75 to 70 is deep washout support. That's where forced sellers often finish and value buyers start to show up. Respect the volatility. Don't try to catch falling knives just because something looks cheap. Wait for confirmation. Wait for volume to dry up. Wait for premiums to stabilize. And if you're new, if you're just trying to understand what the heck you're looking at, here's the takeaway. Markets don't move on opinions, they move on pressure. You can have the best fundamental thesis in the world, but if everyone's leveraged long and margin calls start, price goes down. It doesn't matter if you're right about the long term. Learn to spot where pressure builds. Learn to recognize when positioning is stretched. That skill will serve you in every market, not just silver. So here's what I want you to answer in the comments. Which type are you? Are you holding physical and frustrated? Are you trading and trying to time this? Or are you watching and learning? Let me know because it helps me understand what content serves you best. Now here's where I stand personally. I'm not bullish or bearish emotionally. I'm mechanical. Let me tell you what I'm personally watching. First, I'm watching how price behaves around the 85 to 80 zone. Does selling stay frantic or does it exhaust? If we get a bounce here with decreasing volume, that tells me forced selling is finishing. If we break lower with increasing volume, that tells me there's another leg down. Second, I'm watching the 70 to 75 area, because if we flush there, that's historically where these types of moves find a floor. Not because 70 is magic, but because that's where leveraged longs are completely wiped out and value buyers start to appear. Third, I'm monitoring physical premiums globally. If they stay elevated, downside risk remains paper-driven, not fundamental. If premiums compress towards spot, that's a different signal. It means physical demand is actually weakening. Based on my analysis, this move was structural, not random. The fundamental picture for silver hasn't changed. Global debt is still at record levels. Central banks are still navigating between inflation and recession. Industrial demand for silver in solar panels and electronics is still growing. None of that disappeared because Kevin Warsh got nominated. What changed was the technical structure. Leverage got too extended. Positioning got too crowded. And when the spark hit, the whole thing unwound. If history rhymes, and I think it does, this kind of fracture doesn't last forever. Paper and physical eventually converge. The question is which direction they converge in. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the premiums yourself. Look at the historical charts. Make your own decisions based on your own risk tolerance and timeline. What I'm giving you here is a framework for understanding what's happening, not a prediction of what happens next. If you made it this far, you're thinking critically. You're not just reacting to headlines. That mentality will serve you well. Whether you're holding, trading, or just learning, the people who survive these markets are the ones who understand mechanics over narratives. Share this with someone who needs to see it. Subscribe if you want more pattern recognition like this. And stay ahead of the noise because the next setup is always forming while everyone's still arguing about the last one. Think critically, verify the data, and make your own decisions. Stay sharp out there. All right, quick check before you scroll. It's January 30th, 2026, and if you care about silver, or honestly about how leveraged markets break, you need to hear this. In the last stretch, silver didn't just dip. It collapsed more than 30%, falling from around $121 an ounce to below 85. That's tens of billions in paper value gone. Fast. And yes, everyone's pointing at Trump's nomination of Kevin Warsh as Fed chair as the headline trigger. But here's the urgent thesis. That wasn't the real cause. That was the spark. The fuel was already everywhere. Stay with me, because I'm going to show you what just happened, why it keeps repeating, and how you can spot this pattern before the next flush, not after.